Hey, YouTube, what's happening? Hey, it's another market update on the channel, Freedom Cash Flows. We're all about pulling that money out of the market, putting it in our pocket, right? Um, just gonna start off here with a simple analysis of the major indexes. We'll take a look at the VIX, um, maybe the dollar, some Bitcoin, Ethereum, etc. Nothing major. But just want to start off with a quick disclaimer. This is for entertainment purposes only, to facilitate discussion and engagement and conversation. This is not financial advice. I'm not a financial advisor. I'm not a legal advisor. So don't take it as such. I am using TradingView for my charting, but I have no financial relationship with them or anyone else for that matter. This is strictly for informational purposes only and entertainment purposes only. Alright, so let's get started. We're going to take a look first at the Russell, the monthly time frame, the higher time frames. So why do we look at the higher time frame? We're going to look at the monthly. It just gives a lot of insight and perspective as to the overall macro trend. So typically investors, large institutions, investment banks, insurance companies, mutual funds, etc. They typically buy sell the low high, or they typically buy low to sell high, or sell high to buy low if they short. Some are long only. But they're not typically going to take people's retirement funds, etc., and day trade. So their activity is going to be mostly reflected on higher time frames, 4 hour and up. You're not going to go look at a 15-minute chart and somehow identify institutional investments or trades being placed. Now, you don't necessarily on the monthly either. This is just for analyzing trend and forecasting where it's going to be in the next few months. And when it comes to forecasting, it's very lighthearted. As you know, volatility can kick in anytime and completely take you out, take you out of the market. Um, Now, the higher time frames is harder to do that on. Okay, a lot of day traders have to worry about that. It's a lot easier to make a volatile move up or down on a short term time frame, like 4 or 5 bars on a 15-minute or a 30-minute, right? A 2 hour trade, and then it exhausts. The dealers have to hedge or they lose money, etc. And so that move will come right back to the breakout price, often leaving people confused as to what just happened, but that is what happened. Anyhow, we're looking at the Russell here, the monthly. So I explained why we're looking at the monthly, but the Russell we're going to look at first because these are small equities, these are small companies. So these are riskier investments, just due to the inherent nature of the company. They're smaller, they're less stable. Their position in the marketplace isn't as solid as, say, a blue chip like Microsoft, etc., Coca-Cola. They've been around forever. They're essentially at the maturity phase of their S curve, and they're simply operating, and anything over operating expenses and financing expenses goes into the bank account, and since they're mature, it gets dished out as dividends rather than reinvested for growth. So the smaller equities tend to be growth stocks at the beginning of the S curve. Startups are those currently in the growth phase of the S curve. Either way, they have positive cash inflow from financing, and their operations are not mature, so they don't have positive cash inflow from operations yet. And so these are riskier because they can fail. But if they don't, they lead to high risk, high reward gains. And so that's important because why? Well, when you want to look at both the state of the economy and use this as a confirmation for market tops, it's a good index to use for both. Because when the economy's good and people have lots of extra cash around, their budget's not tight, they're not risk averse, they're going to go spread some money around for those higher rewards. They're going to take on more risk, right? When the markets and the economies go down and they're not very stable, like right now, there's a lot of high inflation, then people are risk averse and they move their money to gold and commodities and dividend stocks, etc. And they, take out some of the risk in their portfolio. And so this index, the Russell, serves both those purposes very well. Now look, you can see we've been in a pretty decent correction lately. It's not a throwback, it's a correction due to the size. Looking at it in hindsight. But you can clearly see here, you have a trend here. If you go to the weekly, and you draw your trend lines, you're in what is called a triangle consolidation pattern. This here is the base, and this convergence point is the apex. Some call it the cradle. Now typically these are pretty tradable consolidation patterns because they're converging, which means the lines are getting closer and closer together, and so as it continues to bounce between the trend lines, it gets tighter and tighter. As you can see here, it was in a very tight squeeze on the weekly time frame. Squeeze is essentially really tight consolidation, which means it will have to break out eventually. And what you see here is a false breakout. It came large green bar up above the trend line and closed above the trend line. Now that's a great sign, but if you're risk averse, you're not going to invest or commit your money to the market until you see two of those. And now here, if you go to the daily, you'll actually see there's a good 2, 3. Pretty convincing, right? Pretty convincing. So if you're trading the daily, and you're looking at this, and you're like, wow, that just broke out. You see how it broke above the trend line? It broke above and then it closed twice. At least twice, but twice is called a two-bar confirmation per CMT. CMT stands for Chartered Market Technician. It's a certification, it's a designation that professionals can earn in technical analysis. Just like you can get the CFA and become certified financial analyst. That's going to deal with more fundamentals. Input costs, output costs, macro, micro, economics, trends, fundamental side of the business, operating costs, revenues, profitability, etc. The CMT is strictly technical analysis. Now, looking at this technically, you see a really decent, confident breakout, right? Two-bar confirmation is considered a positive sign. And if you look at this technically, this bar here closed slightly above this breakout bar, and so that's your two bar. Here and here, two bar, which means you are buying here. When this bar closes, you go long. And of course, risk management's important. So depending on your risk tolerance, you could place a stop. I mean, you can essentially choose what works for you, but essentially you're going to place a stop anywhere from where you buy in back down to the trend line, because if it comes back to breakout price, that's a bust. That's a failed breakout, and as you can see, it failed. It failed, which is not uncommon, so you have to be prepared for that. But if you look back on the monthly time frame, you can see you can use this to time a market top. If this would load. Ridiculous. Wow. Does weekly work? Alright. There we go. Alright, so anyways, you'll see these other indicators I have on here. These are for confirmations and or signal generation. For timing the market. Now look, here's a momentum indicator. Somebody made this custom. This is similar to a squeeze indicator, either made famous or invented by John Carter. He sells them, etc. I have no financial relationship with him, but he does have a YouTube channel. I highly suggest you check him out. You might like his style. He's also got a company called Simpler Trading, and a website and various indicators, etc. He has an interesting style. He does a lot of timing, uses a squeeze, so he's looking for tight consolidation, and then he's saying, okay, this is about to pop in here, and as you can see, when the squeeze ends, it popped good. So he's going to try to get in a little bit early and profit off that increased volatility. But it just depends on your trading style. You know, you might not like to do it that way. You might like to swing trade, etc. It's on you. This is just simple ADX. The volatility I have in bars, just so I can see if it's over 20 or not. Just to give me an idea of the strength of the move. This red and green gives me directional bias. This gives me extreme consolidation, and this second piece of it gives me momentum. As you can see, the momentum changed right here when it attempted to break out and it failed. Right here, you know, you should have saw that on this equity index and said, wow, failed breakout, and been paying attention. That right there is a possible confirmation of a market top. I mean, in terms of evidence, that's pretty solid evidence. For a breakout to bust, not a good sign. Not a good sign. To give you some additional context, you can see the breakout here is above the trend line. And this is a CCI, nothing too custom. It's just standard CCI indicator to help with timing. When you identify real breakouts, it can get you in a little bit early. So the idea here is when it's coming out of the blue, it's signal generation for a breakout, and it's going to be bullish. You stay bullish essentially until it comes back into the blue area. But as you can see, it wouldn't really work too well here. This is a failed breakout. So, if you were to buy right here exactly at the trend line, you place an order, let it break out, and go buy this exactly, it comes back into the blue on this bar here, so it doesn't come all the way back to breakout, so you would have made a small profit, but that's less than ideal, right? Um, but anyway, it does help, especially on trade management. Once you're in the trade, let's say you just use this as a buy point, an action point to go long, set an order, it hits, you're just looking at this. Preferably you go down 1 or 2 time frames to manage the trade so you can see what's going on and catch it a little bit early. But here's the breakout, right? Now right here you're looking, there's a couple of lower momentum bars, and look at that, it comes back into the blue, and so you're gonna sell here, which I believe was 23.87. I believe it was a little bit higher. So if you work the trade, I mean, if you even go down to a 4 hour, you can sell a little bit earlier. So yeah, this closes at around what, 23.44. So you lost about 40 ticks if you're just sitting trading, managing the trade on the weekly. Um, but that's essentially it. I mean, confirmations are important. The price action is important. Knowing whether it's in consolidation or in a move is important. You can't just simply look at price or certain indicators um, in a single isolated fashion. Like, essentially, you want this indicator, and this indicator to all kind of give you the same story. And then you want to see price action in line with that. So, I mean, you see a breakout here. If you're just trading triangle patterns, you're like, okay, that's a breakout. You're gonna go long, but then what? The CCI says, okay, yeah, that's definitely a bullish. Okay, but if you look up here, this is in a tight squeeze still. Where's that gonna go? It didn't end. You've got very little volatility in here to push the momentum up, which is why it didn't go up. And then you have some kind of indecision during the breakout, which ways it's not very convincing, right? It's not like let's look at even right here where it fails. It fails hard, and the red directional bias clearly breaks out. Clearly breaks out. All right, it's pretty obvious when the directional bias is clear in one direction. And so if you're looking at this in hindsight, just at the breakout, you won't be able to see all this. This is in hindsight. But this is to illustrate that you need to really have confirmations and not just simply go by 1 or 2 things. Look at the whole market, all the activity in context, and then manage your risk. Now, you could go in here and you still could have even made a profit managing the trade lower time frames. But you as a trader need to decide if you want to take that trade and take on that risk. So if it's worth the effort. But just wanted to start with this to give you a quick glimpse into how to use this to one time market tops, failed breakout upside, hard correction. Look at a serious momentum drop. There's no volatility in the market, even though the directional is bullish. The bias is bullish, although it's kind of descending. You see they're converging. Not good. And to give you an even more illustration of how the CCI can get you in and out early, create signals early, you look at it coming down into the blue. Look at this. You've got this very bullish here, and it's coming down into the blue as price continues to go up, momentum continues to go up. That is called a negative confirmation. Here's a positive confirmation. It goes bullish, it breaks out hard, price moves hard in the same direction. Momentum moves up in the same direction. Directional bias moves up in the same direction. Volatility may or may not be in the market. That's its own separate piece that you have to manage separately. But looking at this, you could have timed the market top pretty easily, in my opinion. At least, if you're a long-term investor, you could have at least used this to hedge a short. But this is a really good illustration of how to look at price, look at consolidation versus trend, recognize when it's consolidating, recognize when it's moving, when it's trending, and then use confirmations as much as possible. Negative confirmation, a couple of decreased momentum bars. Like right here, you're going short, even though this is up. Like you've got price action way up at the top of the range here, yet the cash flow is coming out. That's interesting. Okay, well, maybe like these three bars are a consolidation before a continuation upside. Totally reasonable. Totally reasonable to forecast that. And as you can see, it did try to continue actually, but the breakout failed. The breakout failed, and so what you get is essentially this: a market top. A market top. Now look at this. The S&P 500 futures. This is back in 2020 COVID. Black Swan, dipped the market hard. Been on an uptrend since. But look at the CCI. It's a negative. It's a negative confirmation. You get price the highest it's ever been, and you got the CCI, the cash flow, essentially dipping into the blue. Cash flow is just coming out of the market. Lower momentum, not good. Directional bias is coming down, and look, now they're going to cross. And so once you see one or two of these blue bars here, you really need to start. I mean, especially when you've got a negative confirmation. You got the CCI, the highest peak here. Price continues. Like, look at this bullish momentum here. It carries price up all the way here, even though cash flows slowly coming out of the market. So right here, cash flow's coming out, momentum's dropping. Now, if you're looking right here, it's kind of hard to tell the directional bias is dropping. I mean, it kind of dips a little. But you're looking, there's no volatility. Where's the volatility? I mean, it could come in any second, but like, it's less probable. It's less probable on a monthly when you have two blue bars in a row. It's less probable that it's gonna go super volatile and like look at how much it came up. Like that's ridiculous. And so it does help to know fundamentals, but from a purely technical standpoint, you're going to have tight stops, good risk management, and you're going to use confirmations. Low momentum, cash flowing out, a ridiculous uptrend with a negative confirmation here. You've got the Russell screaming market top because these are small equities, very risky. When the markets go bad, the risk is high. They sell these off. They don't wanna lose their cash. They need to keep their capital secure. So at market tops, the Russell sells off. So a lot of that is how to time market tops and bottoms. Okay, same thing here. Same exact thing here. COVID dip, massive trend. The Federal Reserve printing money, buying up assets, propping up the economy during COVID, and then the momentum just carries it. And you have the CCI at a peak here, yet price is highest here, and the CCI is coming down, cash flow is coming out. Not a good sign. Momentum's coming down, right? Two blue bars in a row, that's no good. You have some volatility in there, so you better be careful with your risk management when it's volatile because you have no idea what's going to go on. It can come in and out hard. Directional bias, I mean, this is long-term trend, so it's not quite. I don't use it. I don't rely on this. I would say rely. I don't rely on it too heavily on a monthly. Maybe more on a daily or lower, down to a 1 hour, 30 minute. But I mean, hopefully you can see how confirmations and just taking the market into context, looking at other equity markets, looking at what's in the market, the underlying pinnings of that market, the nature of those. And you can see they all kind of do the same thing. A negative confirmation on the CCI coming down, price action going up with momentum taking it up as cash flows coming out. Then you get a couple of blue bars of decreasing momentum, typically as price peaks, and the CCI will be basically flirting with the top of this line here, this blue. Not a good sign. Not a good sign. So, and so that's that. The VIX. The VIX is an interesting index to use to measure, well, one fear in the market, but also essentially the daily moves. So if you're looking at, we're in the wrong one. We need to be in the VIX, not that one, not the S&P VIX. Well, different S&P VIX. But here we're at a 25.72 VIX. So what does that mean? Well, you can divide it by, I think it's 17 to get the daily. Let's see if that math adds up. That's from memory. I might have to go check that. It explains this concept in the CMT material, which I highly suggest you get just to learn even the level 1 fundamentals. It will give you a really good foundation for any type of trading you want to do. But yeah, 17, so 1.51% daily moves. Let's go to the daily here. Like if you look here, you can kind of see it moved what, 6%, but I don't know. what that's showing for, if it's for the week or the day. But let's see, so like 17% down to 22, that's a little bit more than 2%, but here's 15, right, down to 18, but it kind of closed 16.6, opens at 14, at 15-ish. Right, and you can see most of the bars are kind of like small. They do have some wide range, but like you can kind of guesstimate the average moves for the day. Um, right, and then come here.